Started. I'd like to say good afternoon or good evening to those of you on the East Coast. I'm on a West Coaster. And, thank you so much, you guys, for joining us today on this first day of fall. Some of you may know me already and some of you may not, but I'm Erin Frico and I'm a real estate investor and educator. And I am one half of the co-hosting duo of the Capital Classroom, where our webinars, we hope that our dream and our desires to educate investors on the world of commercial real estate. So you feel better equipped to make smarter, more informed decisions on the opportunities that are coming your way.
Hi,
If
everyone. Welcome. My name is Tammy McDonough. I'm a real estate investor and your co-host with the lovely Erin Frigo. We are thrilled that you're here on a Monday evening or afternoon, like Erin said. It's great to see some familiar faces. You're about to hear from our guest speaker, Miss Vesey, but our goal is simple. We just want you to learn, grow, and invest with confidence. A quick disclaimer, because we have to do this boring thing here. We are not attorneys or financial advisors, so all of the information that we're providing you is for informational purposes and educational purposes only. So without further ado, give it back to Erin.
Thanks, Tammy. So, you guys, we have a real treat for you today. We are so excited to welcome Miss Vesey Kapulian. She's founder of Dream Believe Achieve Capital Group, and today's guest speaker, or rather, she's going to be our guest professor, as Tammy and I like to say here at the Capital Classroom. Vesey has a BA from the University of Arkansas and an MBA from Northwestern University. She began her real estate journey in 2017 and today oversees a portfolio valued at $80 million across Florida, Tennessee, and Georgia. With over 15 years of experience as a commercial lender and business management experience, she brings a sharp and, what I love most, very conservative and highly analytical approach to underwriting deals, assessing risk, and maximizing returns. Vesey is known for her solution-oriented mindset and execution-focused style. She has been a trusted asset manager and key player on several projects. Beyond the numbers, she is deeply passionate about educating investors, which is why she is here with us today. And she wants to make sure that people truly understand what they're investing in so they can make smart, confident choices. Her blend of expertise, integrity, and genuine care for others makes her an incredible resource, and we couldn't be more thrilled to have her guide us on today's session. Bessie, whenever you're ready.
Thank you so much, Erin and Tammy. Thank you for having me. Thank you for the warm welcome and the very, very kind introduction. So I appreciate that. Very excited to be here today, share my knowledge, and my hope is that every single person who's attending live today or catching the recording can take away at least one golden nugget that they can implement in their investing journey starting today. So I guess we can get started. I shared with Tammy and Erin that I'd like to keep this interactive, and there are really two key questions that we discussed, and as I understand, you guys wanted to really learn more about, and that is why real estate. And instead of preparing a PowerPoint presentation or something more formal, I thought I would start with a story. And so I'll start there. I'll give you some ideas in terms of how to think through the starting points, but I really want to keep this interactive. So regardless of where you're at in your investing journey, I welcome questions. You don't have to wait till the end. Feel free to ask, pause, unmute yourself, put them in the chat, and then really would like to make this engaging versus a monologue and talking to myself. But very briefly, I grew up at a very, very different time, very different place. And as I reflect on my journey, I often like to say that the seed in real estate was planted in me many, many moons ago in a different time, different place. But it didn't quite germinate until many years later. I grew up in Bulgaria behind the Iron Curtain. Um, a very different environment, but at the time when people spoke about investments, they often referred to hard assets. And that's why I like to think that that seed was planted way back when, although it took me many years to realize that. I didn't come from a family of means. We were by no means poor, but I definitely learned the value of a dollar from an early age, and uh, doing recycling in the summer times, earn pocket money, being very, very conscious of spending within the family. It was always my dream to come to the US, and there was no plan or AB. There was only one plan, and that was to earn a full scholarship. Without it, that would not have been possible. And so I started with step one, which is learning English. And then from there on, applied to a number of colleges, universities, was very fortunate to be accepted into a couple, ultimately chose one. And when I came to the US, I chose or followed rather the traditional path of going to school, joining a large corporate firm and starting to climb that corporate ladder. Why? Because for many of us, for a long time, really, even if you, I'm not sure if how many of you can relate, but even for our parents, right, success was getting a good job and staying in that job forever, right? And so that was kind of the mindset that was instilled in me: get a good job and progress over the ranks. And at that time, everyone's dream was to be a CEO. I figured, okay, I will be a CEO. So I got through my education, joined a large corporate, started climbing, and a few events of adversity really led me to realize that I was climbing the wrong ladder. One, there were exogenous events like there was the Enron scandal that you probably remember that left a lot of people without retirement. Then the 0809 crisis, which left a lot of people without retirement portfolios, in some cases without jobs. My own employer went through a couple of restructures, and I'll never forget the day when 7:30 a.m. one of my colleagues texted. He was one of my peers, saying, "Hey, I'm not going to be coming to the office today. I just got laid off." And he had a very quirky sense of humor. So I said, "Don't joke about these things, because I also believe in energy and mindset, thought, and don't bring these things." But he said, "No, I've been fired. I go to the office." And at that time, only to find out after making a number of phone calls, since the managers were not present, that 70% of our team was gone. And I felt really, it was sad. I was scared. These were people, very talented, smart, bright, who some had spent 30, 40 years with the company. They were by no means ready to retire, and others, like my peers, who were effectively being let go. And at that time, I realized I was spared probably by a miracle, and probably because I was underpaid, because oftentimes these are cost-effective decisions and driven by cost considerations. So I ask myself, well, what do I do? What if I'm next, right? And whether it's with that firm or any other firm, no one is insulated. And that's when I think that seed really sprouted. And I thought to myself, well, I'll just buy a single family home, and that will be my retirement nest egg. That's the scale that I thought it. And it was aspirations, but also fear that was driving my decision. At the time, I was, and still am, based in Southern California, where to own a home here, right, the median home value is about $1 million today. It was a little bit less than that previously, but in either scenario requires a pretty substantial liquidity. The regulatory environment here is a bit tougher, and certainly for a property to cash flow, you pretty much have to buy it all cash. And I didn't have the means. I wanted cash flow, and I didn't want to worry about the regulatory environment impacting my business. So that naturally pushed me to invest out of state, did my homework, and I was attending various real estate seminars, groups, very much like the Capital Classroom. And there was one particular speaker who would often say, "If you have any questions, call me." So one day I called him. I said, "Hey, you said you invest out of state. Do you know someone who sells properties there?" And sure enough, he did. And that's how I got my first home. I always thought that I'm supposed to invest in my backyard, but that was not really an option for me. And that's how I got started. That first home turned into a second, then into a duplex, and then the light bulb went on, and I realized, wow, this is not just a small retirement nest egg that will be there for me if, God forbid, when one day when I retire, either the market or my employer does something unexpected. And I asked myself a question, well, how do I scale it? And it became very clear very quickly to me that I'll have to buy hundreds of single family homes. And I thought there is a better way. And that's how I found out about syndications. Now, I did know about apartments and commercial properties through my work as a commercial lender. So that's the job I was doing for 15 plus years. So it wasn't necessarily, I guess, a new concept, but from an investor perspective, there is a power in leverage of people, people's skills, and then also capital. Doing it alone is not impossible, of course, but it takes longer. And at one point or at some point, you get capped, right? Either in terms of time or capital, and very often both. And that's how I started my multifamily journey. Fast forward a few years later, um, July 22nd, 2023, 9 a.m. I walk into my office meeting with my manager. That ended up being a very brief meeting, and I was told our entire division is getting shut down, and I am being impacted. And it's still very painful to share that. I don't think that will ever go away, although the wound has crusted for since then. But at that time, yes, I was sad, I was hurt, I was angry. I mean, there were all sorts of emotions going through my mind, but I was also not panicked. Why? Because between the prior layoff and the one that occurred that impacted me directly, I had been investing in real estate, and that was over a number of years. So when that happened, I was somewhat prepared. I say somewhat because my small portfolio was generating sufficient cash flow to cover my very basic living expenses, right? And I never really I didn't grow up with a lavish lifestyle. I never lived a lavish lifestyle, so that also helped me accumulate a very healthy savings reserves. And so when that event happened, when the layoff happened, thankfully, I had options to consider. I wasn't forced down a single path, meaning finding another corporate job, starting the clock at ground zero with vacation and benefits and all of that, and really hopping from one rat race into another with no guarantee that this won't happen to me again. Thankfully, I had options to consider, and it was always my plan to be investing in real estate full time and to be helping other people do the same. And so when that happened, I had options to consider, and I decided to bet on myself and go into business full time, which is what I've been doing now for the past couple of years. I'm not necessarily brand new to real estate, but being into it now full time, which has allowed me the opportunity to help many more people not only invest in real estate, but also with the education process, because I believe an educated investor is an empowered investor, and that's where my journey started, and that's why I always recommend that people start there. So let me pause for a second, see if there are any questions before I transition to the next item that I wanted to share with you.
If anybody has any questions, you can just go ahead and unmute or type it in the chat.
Bessie, do you still have, most of the single family portfolio you developed?
I still hold that, yes. So I was never a flipper. I mean, there are different strategies that you can utilize starting in real estate. Even with my multifamily, those are typically 5 to 7 year holds. So all the properties are still within my portfolio, both at the single family as well as multifamily route.
Anybody?
Wesley, Yeah, I don't know. You might have mentioned it, or maybe I did not hear. At what point you made the switch from single family to multifamily or commercial side? Did
Mhm.
you mention it about that?
Great question, Adi. Yeah, so after a few properties, that's when the light bulb went on for me. It's like there has to be a better way. So I know in single family, they always talk about get to the first 10. And I think that's a great strategy. I mean, utilizing the Fannie Freddie loans, because those are amazing loans, 30-year fixed rate, that you can refinance with no prepayment penalties, right? But those are usually capped by your earning ability, right? Capped by your earning income, because then lender is underwriting you individually. Whereas with a commercial property, of course, they're also underwriting you individually as an operator. They're looking at your net worth, they're looking at your liquidity, they're looking at your operational experience. But ultimately, what they're looking for is the primary source of repayment, which is the cash flow from the property. So that's where scales becomes easier as long as you partner, right, with others. It's very difficult to achieve this on your own. But after a couple of properties, that's when the light bulb went on for me, and I realized I why wait? What why do I have to go through getting 10 properties and then making the jump? Why not now? And that's how it happened for me.
Bessie, what was your first role in your commercial property? Like, were you involved in a syndication or was it something different?
Great question. So, the actually my first multifamily was a small 11 unit joint venture. So everything has been very gradual, single family duplex 11 unit, then 150 unit syndication. But each step taught me an important component of the process, whether that's operations or analysis. And so the very first property, when I initially started in the space, I geared more towards the acquisition part of the equation. And just for everyone's background, in syndications or in commercial real estate, there are three main verticals. One is acquisitions, that's the people finding the property, talking to brokers, analyzing the deals. Then you have asset management, that's the team that operates the property on a day-to-day basis. And then you have attraction of capital, and these are the partners who effectively bring the money, because and you need all three, right, to bring down a deal or put the deal together. So I started on the acquisition front, and a lot of that entailed calling brokers, building relationship with brokers, getting in on their lists, starting to get the deal flow, analyzing these deals. And I was determined. I really wanted to make that work. So over that initial 6 month period, after I made more formally made that transition, I was analyzing a property almost every day. So it took looking at nearly 200 deals, of which I want to say 3 to 5 were worthy of an LOI, and of those, only we won the LOI for one. So it's definitely a numbers game, and I share that with people because it really does take that much. And obviously the market has shifted since then. Deal flow has collapsed for a variety of reasons, and we can talk about that in the current market environment as well. So it's never easy. A lot of people tell me, "Oh, it was you had it easy before because there were a lot of deals." And it's like, yes, there were a lot of deals, but there was a ton of competition, and oftentimes brokers wouldn't even return calls or emails. So you have to be really, really persistent to really get a response and get in on their radar and build a relationship. Now it's not any easier because deal flow is down, or it's starting to come back up. But at least last year, right, it was down like 80%. Not as many deals, but then at least brokers are more engaging. Now they're calling you. They're looking to build the relationship. But yeah, my first role there was finding the deal and underwriting the deal. And throughout that process, I also built relationship with other people within our common network. So I joined a mastermind group in order to effectively get in those circles, right, and find my future partners. And throughout that experience, I wasn't shy about sharing, hey, I'm good with numbers, I can underwrite properties. And eventually that's how I landed also my first syndication. It was through providing underwriting expertise, found a deal, the numbers worked, and the general partners asked, "Hey, well, do you want to be part of it?" And that's when I said, "Yeah, of course. I mean, I like the deal." And they said, "Okay, great. Now you also need to capital raise." I was like, "What?" I did not sign up for that. Remember, I'm the underwriter, the person who's kind of sitting in a room somewhere by themselves. So I still consider myself introverted, although since then I would probably say I'm the an ambivert, I think is the new terminology, introvert and extrovert mix. But happy that that opportunity was presented to me, because now throughout that experience, I also discovered that I actually enjoy attraction of capital, because that's what really allows me to connect with investors and provide the education and answer the questions that they need to know or want to know in order to make an informed decision. So a long-winded way, but hopefully that answered the question.
Any other questions before she continues?
Yeah, actually, I have a question, Bessie, if you don't
Yes,
mind.
of course.
Yeah, so you said that once you wanted to start doing acquisitions and then you got
Mhm.
hit with well, can you bring capital to the table? What strategy did you go about when trying to find private investors or finding that capital for these deals? How did you go about it?
Yeah, so I started with people within my immediate network, right? People who knew me, who had some familiarity with me. So you often hear the term friends and family. And I learned another very valuable lesson, right? Just for perspective, for that particular deal um, that I'm sharing about, we had the investor presentation on a Friday, and by Sunday evening/Monday morning, we were oversubscribed. So I didn't even have a long time to to do that. But prior to that, actually, again through some of those networking relationships, there was one operator who said, "Hey, if you can raise 250,000, you can get a GP spot on the deal, be part of the asset management and all that," which is really uh, not an unreasonable number, even for a first time race to start with. So that was actually, even before that first official deal, I had to earn my stripes the hard way. And I tried to raise, I almost raised 250 and ultimately was zero. So why do I say almost 250? I was speaking with a friend of mine, and when I shared about the opportunity, she said, "Yeah, I want to put in all of our money in there, 250,000." I said, "Wait a second, you shouldn't be doing that." And she got a little taken aback. "Why is that?" I said, "This is all of your savings, right? So you always need to keep aside. You're welcome to put in a smaller amount, but you by no means should you be putting the full 250,000." And I'm glad that we had that conversation, because ultimately she ended up not investing, because they were going through either invest passively or do an active investment. They opted in for the active investment. But I always encourage people have that conversation, because these are long tenor deals. You don't want to it's not like a stock where you can trade it easily in and out, right? So once that money is in, it's locked up. But what I learned through that experience, Alex, is that with my first raise, right, which was a flop effectively, but a very, very valuable learning lesson, is one, when I first approached people within my circles, they knew me as Vessi, the commercial lender. And so when I said, "Oh, I invest in real estate now," their first question was, "Oh, you're a realtor?" I was like, "No, I'm not a realtor, not a real estate agent. I invest in commercial properties." But it caught them by surprise, right? So one thing I had failed to do is gradually share with them step by step, "Hey, this is what I'm doing on the side. I still have my daytime job." Really explain to them the benefits of commercial real estate, and how they can get engaged or why they shouldn't get engaged. Secondly, throughout that process, I also learned that, with some people I had emailed, some I had texted, in other cases I had posted on social media. Same people, but they each responded in different ways. So that was another aha moment. Oh, everyone consumes information differently. For some, it's email, for some, it's phone, for some, it's text, for some, it's social media. So you cannot go wrong by utilizing all distribution channels. And so when the second raise came along, yes, I raised some capital. It wasn't a tremendous amount, but I did better than the first raise because I had implemented some of these learnings. And by the time the second race came along, I had already started building relationships. People were not as surprised to hear about what I do. They were already at least somewhat educated. And a lot of these conversations also gave me ideas on topics that I can share, because oftentimes the questions you hear from people are very often overlap. So it gave me ideas on what topics I can share with investors. So by the time they come across a deal, it's not a completely, it's not a complete surprise, right? They already feel educated, prepared to make a decision. So hopefully that answers the question. But yeah, it started with the immediate network, many mistakes along the way that I learned from, and from there I grew.
Yeah, that's a good point. You definitely have to warm your investors. It's like dating, right? You can't,
Well,
you have to take
yeah.
them out a few times. Yes.
Absolutely. I mean, and the minimum investment is what, 50 to 100,000. So it's natural, right, for a lot of people to be skeptical. And I definitely don't want to get off topic, but now with AI, right, you probably hear me often saying that we're in a relationship recession or authenticity recession. You don't know who's real, what's not. And just the other day, I mean, I am embracing AI and definitely want to implement in my business, because that's where that's the future, right? We lived through the industrial revolution, we lived through the .com and the internet revolution. Now we're at the AI revolution. We're not going back. But it's very concerning, right? When there's a program I learned about, HeyGen, where you can literally put a script, your voice, and it creates a video of you. Well, what if the video you're watching is not me? What if it's some imposter? Or the Google VEO3 video? It's unrealistic real. I mean, it's phenomenal. The quality is so good, but what if it's not me? Right? And that's where I think those touch points of in-person touch points are extremely, I think, will become even more important. Yes, we live in a global society, and Zoom has made things a lot easier for us to connect across state lines and oceans and borders. But having those in-person connections and authentic relationship, I think, will be even more important now than ever.
I hope this is the real you right now, Becky. Not
Absolutely, yes.
I hope this is you. What can you do to let us know it's really you?
Yes, I promise. That's still the imperfect me. Yes. So, but I wanted to share actually a simple one calculation with you, because a lot of people ask me, well, how do I start? Or they say, well, I want to live off of passive income, and that requires a little bit of math, not complex math. So don't worry, but I do want to share with you, for those of you who may be at the starting point of the journey and want to figure out what does it really take to get to where I want to get to. And I mean, I did these calculations myself when I was starting. So let me hit share. Um, and let me know if you're able to see the screen. And by the way, I'm happy to share this Excel with anyone. It's nothing complex or uh, patented, or any of that nature.
It looks
Um,
good, Bessie. You can see it. I don't know. Do you thumbs up if you need it bigger, or is it okay? Feel free to unmute.
I
Can
can make
everybody
it.
see it?
It's good. It's good.
It's good.
Okay,
Okay.
that's better. Perfect.
Okay. So it comes down to really two simple calculations. And so one is cash on cash return, and then the other one is equity multiple. And there are a few other return metrics. We can go into those if you guys would like to. But let's just say your ultimate goal is to retire and earn passive income, whether that's real estate or other investment. It really comes down to two key variables. How much cash do I have deployed working for me at any point of time, right? And what is as far as the income coming in, what is that cash on cash return? For every dollar invested, how many cents or dollars, right? In most cases, it's cents, do you get back? And so let's just say you want to, for many people that I speak to, the 10,000 seems to be the magical number. And of course, that number varies depending on which part of the states or the world you live in, what your lifestyle is, and what your other obligations are as far as family, educational needs, medical needs, and whatnot. And let's just think through the average cash on cash return in a multifamily syndication today is anywhere around 6 to 8%. It ranges. I think average in the stock market is around the same amount. So for you to get to that $10,000 a month, and let's just say I'll be more conservative, right? Just in case there are any fluctuations. Let's just say that's 5%. If you invest $1 million, that basically, if you have $1 million deployed at any time, that basically translates to about 4.2 thousand dollars of income a month. So really, to get to a more closer to that 10,000 number, you need $2.4 million. And you might say, "Well, I don't have $2.4 million." Well, I can promise you, nobody is born and a $2.4 million check handed off to them right at that point. It takes some time to get there, and that's where the equity multiplier effect really comes into place. So ideally, right, in multifamily, the typical equity multiplier is anywhere from, I would say in the current market environment, it's probably 1.5 to 1.8. When the market was really strong, and I do believe eventually we'll get back to those levels in a few years, maybe not in the next year or two, but it was 2 times, right? It takes for the principal to double every 5 years. And so let me know if you can see the next sheet. I'll enlarge it a little bit. Are you guys able to see it? Because sometimes with Zoom, when you switch over, it doesn't always connect.
It switched.
It switched perfect. All right. So what happens, right? Let's just forget. There are a couple of different scenarios, right? In a different way you can approach it. Let's just pick a middle number and say the equity multiple is 1.5, and then you start with a $200,000 investment that doubles every 5 years. So then you can see that by year, what is it? Year 20, you get close to that 2 million number. And you may say, gosh, 20 years I have to wait? And the answer is yes. It takes a long time. Real estate is not a get rich quick game. It's definitely one that requires a lot of patience. Now, again, I picked a very low return, right? I picked 5%. I picked 1.75 equity multiple. You can probably do better if you're willing to take on more risk, right? But not everyone has the same risk tolerance. Alternatively, you can say, well, I don't have $200,000 today, but I got my annual bonus and I can invest that. And in 3 years, I can invest another 50,000. And in 3 years, I can invest another 50,000. Then again, over time, you still can get to, in this case, looking at 28 years, right? It's a long time. You still get to that 2.1 million number. Now, if you invest every year, if you invest a larger amount, of course, or if you invest in deals that produce higher return and have higher equity multiple, of course you can accelerate that number, both the timeline as well as the dollar amount. But what I really wanted to illustrate with you is that it takes time, and it definitely took me some time to realize the saying, they say, I think it's a Chinese proverb. Yeah, the best time to plant a tree was 20 years ago, and the next best time is today. And that could not be more true. I think really for anything in life, but especially real estate, because the only way to make up time, right, is to either invest more capital, deploy more capital, which you may or may not be available to you, or take on more risk, which you may or may not be willing to do, because with higher risk, oftentimes people say high risk is high reward. And sure, that's not incorrect, but I also like to say high risk or high risk equates to higher probability for loss, right? So you also have to be comfortable with that concept. And so the best time to start is really today, and you don't have to start big. You can start with a single family home, then a duplex, then a quad. Um, if you're absolutely busy and don't have the time or desire, right, to deal with tenants, toilets, termites, drama, and whatnot, then you can invest passively. But what I also like to tell people is, and that really like upsets me sometimes when I see on social media when people talk about passive investing, and the typical picture is someone laying on the beach with a umbrella drink, I don't know, pina colada or something, and just enjoying their time. And I'm not saying that's not impossible, but the passive side of passive investing is not being involved in day-to-day operations, right? You're not the one knocking on tenants' doors, collecting rent, dealing with maintenance and whatnot. But it's a very active experience on the front end because you must do your due diligence. It's not any secret that commercial real estate is going through its winter season right now, and multifamily being part of commercial real estate is part of that. And I talk to a lot of passive investors oftentimes when they need a second set of eyes on deals, or when they're unfortunately going through capital calls and other situations. So yeah, so in a lot of these issues, you cannot eliminate them, okay? That's like, there's absolutely no way to eliminate the risk. All investments come with risk. So, but you can mitigate the risk or minimize the risk of loss by doing your diligence on the front end. And that's really digging deep on the operator, then the market, and then the deal last. And by deal, I mean both the numbers and the structure. And once you do a few, right, you learn, and then it gets easier over time. It's like building a muscle, right? Easier to lift the 10-pound weights when you start with 2 and then 5, right? You build up over time. But it doesn't come without work. So anyone who's telling you passive investing is passive is yes, you're not managing the day to day. That's absolutely true. But it doesn't mean that there isn't some work involved on the front end. And I would even argue throughout the tenure of the investment, you really have to monitor your investment to know how things are going, looking at the numbers, reading the updates, because the last thing you want is to be surprised and find out that the operator has been communicating to you all along, and you only paid attention when the check stopped coming, or when you were asked to put in more money in the deal. So let me pause here. Sorry, I tend to share a lot. So,
No, I
see,
think it's great. I think because investing in real estate can be lucrative, but you're giving a very realistic approach to what it is like. And, it's not all glimmery and glittery. And I think that everyone here can appreciate that realistic approach. So thank you. So if you have questions, just jump right off of mute and go ahead and ask.
Anybody have a question?
Bessie, I have a question.
Mhm,
So since
mhm.
you've been involved in this for a long time, have any of your deals come full cycle? In terms of that 5 to 8 year sort of window that we kind of all look at when we've been asked to invest as a limited partner.
So, not on the syndication front.
Okay.
I think the soonest one will be 2 years from now when it
Okay.
comes due, or when the official business plan expires, right? Um, so there is some time, although I will say for my very first deal, that 11 unit joint venture. I decided to exit that for a variety of reasons. So that has come in full cycle. But the syndications, and then I think Steve asked earlier, the single family portfolio. I'm a passive investor as well. Sadly, one do came to a halt. Which officially this year it was declared as a Ponzi scheme. So that was a very painful experience, and I can definitely talk a lot about that. So I guess yeah, that one has come to a full circle, but it was very, very painful. Which again, a lot of lessons learned there. Um, Not only from a passive investor's perspective, what to look for, but also for me, because I also a co-partner or partner on syndications with others, is what not to do as a GP and what behavior I don't want to ever see in partners, or things that I wouldn't want to ever do myself.
So I have I guess a comment and a question related to
Mhm.
that. Ponzi scheme is a term that comes up, right?
Mhm.
When you talk to folks about this who are unfamiliar with this,
Mhm.
they frequently ask, "Hey, is this a Ponzi scheme?" So you had the unfortunate experience in being involved in this.
Mhm.
I would ask your perspective on what to look for, right?
Mhm.
How have you learned to avoid that?
Mhm.
And how do you answer that
Mhm.
question you
Mhm.
get it from other investors?
I really appreciate the question, Holly. So let me start with the first part in terms of what I learned, or what to look for. And sadly, as a lender, I actually prevented two major fraudulent schemes and actually wrote an article on it on how to avoid a scam. Um, the one key difference and why I couldn't stop this one is that as a lender, I controlled the money flow. I literally could see every single transaction. So that visibility, plus me asking a ton of questions, which I always do, and sometimes that tends to annoy people, but that saved my now former employer multiples and millions of dollars, because I was able to stop um, both of these. Now, the one that occurred to me, the main difference is that I did not control the money flow, nor did I have visibility into the money flow. And that's not unusual, right? As a passive investor, you don't necessarily get involved into the day-to-day accounting. But there are a few mistakes that looking back, I did then that I see now. Again, at the time, I thought I was checking all the boxes, right? A little did I know that there are a few things that I missed. One is the mistake I did is trusting the operator endorsement status, right? And you have to trust the person, right? If you don't, I would say don't do business with them, whether you're working with them actively or passively. But in that case, it was someone who was very, very well known on social media, someone who would often take photos with celebrities in the industry, which comes as a form of endorsement, very successful at raising various funds, various asset classes. Um, and they often say trust but verify. I asked a lot of questions before I got into the deal, but what I subsequently learned, and what I encourage every passive investor to do, is ask for a sample of the reporting, right? And so one thing I discovered, and that's not at all uncommon in the industry that I see today, where a lot of people raise the capital and then they disappear, right? They may not answer your questions, or they simply become paper pushers, right? They forward the syndicator's email to you without any thought or commentary. Unfortunately, in this case, and it wasn't just this particular fund manager, it was many of them, were not really requesting or reading the financial statements. Well, if you're not reading financials, there's a very high chance if something goes bad, you're not going to catch it. And unfortunately, that's what happened here. So asking for a copy of the monthly communications. Secondly, I do remember vividly, right, during my second, or I think it was third round investing with them. It all started well, by the way. Everything was coming on time. It was someone almost like a Bernie Madoff, right? It was someone who had been through multiple economic cycles, never paused distributions. Now we know why. Um, Someone who's presumably passed background checks, squeaky clean, just like Bernie Madoff, right? And then when the recession started, things imploded. And this particular one has hit not only multifamily, but other sectors quite a bit. And that particular deal, by the way, was not in apartments. It was a different asset class. So another lesson learned is stay in your lane. Often people talk about diversification. That's absolutely very important, but there is a fine line. When do you start diversifying? So I don't think I'm quite there yet, which is why I stay in my lane, which is residential, whether that's single family or apartments. So social media personality, ask for a copy of the financials, ask for additional information. I remember asking for the contracts, and initially there was some pushback by the syndicator, and got on the phone. He walked me through the process that he had gone through. I got, I guess, a little more comfort after speaking with him. But knowing what I know now, I should have asked for a copy of these contracts. They were described as highly confidential and this and that. And, you can always offer to sign an NDA. Of course, things are confidential in this business, but you can always offer to sign an NDA to look at the information. And of course, honor the NDA. Don't go then spreading it around to competitors. Um, but those were some of the lessons learned. And if people decline to share information because that's how they run their business, it's a lot easier now for me to say no. And I'm well aware that by doing that, I may miss out on a great opportunity or one that turns out to be a great opportunity down the road. But right now, I'm really more focused on not losing more money than I already have, right? And
Right.
preserving the capital, because the money you lose, right? You must find another amazing deal that doubles your money over a 5-year horizon just to break even. So it's going to take me at least 5 years just to break even, right? And make up the loss. So that's why, like, a lot of people say, sometimes I feel like automatically Warren Buffett's rule, but it's so true. Never lose money. Um, and now I think the second part of your question, could you remind me? So first one is lessons learned. Um,
And then how do you
oh yes, how do you respond
respond?
to it? Yes,
Right.
yes. And so it really starts with education, right? Education and transparency and walking them through the process. And oftentimes, even with my investors, I would invite them to listen in on a deal just so they can see what the process is like. And when they're comfortable, right, they can engage. Because the last thing I want is for someone investing in a deal and, one, not understanding what they're getting into, and two, losing sleep every night for 5 years. That's a miserable life. I don't want that for them. I don't want that for me. So it really starts with patience, education, walking them through the process. This is how we evaluate the market. This is how I evaluate the operator. This is how I evaluate the deal. A lot of my investors know that if they come to me with information, I share that, and I don't hide bad news either, right? In my investor updates, that always comes first. I don't sandwich bad news between good news. I don't put them in the end, hoping no one ever reads them. I always start with the bad news. Here are the challenges. So it really boils down to approach of being an educator, um, communicating transparently, not being afraid to get in front of the bus. I find that often people are afraid to share bad news, and of course, I don't like sharing bad news either. It's uncomfortable, it's unpleasant. Nobody likes to do that. But what investors hate the most is the lack of transparency, or delayed communication. Lenders, by the way, don't like that either. I can tell you that as a former lender, I had a lot more forgiveness for borrowers who came to me proactively so that we can figure out a solution together, versus waiting till the last minute when things may be too difficult to turn the plane and the ship. But explaining to them, here's how the paper trail works, here's how the money flow works, patiently answering their questions. That I have found to be helpful in terms of overcoming that concern, because it is a real and a very valid concern.
Yeah, that's super helpful. Thank you.
Mhm.
Hey, Bessie, two questions.
Mhm.
One was you were talking about trying to get a contract.
Mhm.
What I might have gotten lost in that. What contract are you trying to or asking for?
Oh, in that particular case, so they were selling and leasing ATM machines. So they had different contractual arrangements with various parties. So I just wanted to see, hey, are these ATMs real, right? Are these contracts real? Because that's the source of
Yeah.
revenue, right?
Okay.
That feeds the business and then feeds my distributions. Now, again, pretty sophisticated scheme. So doesn't mean that the contract they would have showed me is real. In fact, we're finding out now that the guy was making up things, but it's still beyond me how the fund managers didn't catch that for years to come. I can understand if they got in on the last year or two, but these are, people who partnered with him for years, and presumably they went and randomly picked machines to check and identify, although now I'm learning that was a prefabricated list provided to them. And so um, it hurts. I'll tell you that. It
Yeah.
hurts. I don't know if I'll ever see my money at this point. So that was a very, very painful lesson learned. And anytime you see things like guaranteed returns, high returns, that's always previously I would have said pink flag. Now it's a very definitely red flag for me. Um, even in multifamily, right? Like I don't mind getting a 14 to 15% IRR. I would much rather get that and sleep well at night than aim for something higher. A lot of people now are getting into buying businesses and this and that, and yeah, they have higher equity multiple, but I can tell you, I finance businesses. This is not smooth sailing, and the cash flow doesn't always flow, right? You need to manage. There's so many things that you need to manage. Right? That can be a whole other master class, but naturally that comes with a higher risk as well. So anytime you hear high returns, guaranteed returns, I mean, this is a real business and it's not easy. It's not at all easy. So there are no easy things, no easy returns here. So if anyone is promising that, for me, that's automatically on the red flag alert, to dig deeper, assuming I'm even interested in moving forward. And if they don't share information for me, like a big thing for me is in multifamily or any other business, getting a copy of their underwriting model, ideally in Excel, ideally unlocked. If you're putting any barriers, well, that just makes it harder for me to get to the number and more likely for me to decline a deal. Because if they're hiding information from the start, what is it to tell you that they would be more transparent once you close on a deal?
So,
So,
oh, was it how? Go ahead.
oh, I was just going to say, so like in the equivalent in multifamily, right? Because not everyone is investing in machines or businesses. Um, the equivalent for multifamily would be, um, hey, like I wanna see the property or a copy of the at least the purchase contract that shows, hey, so and so is buying this property at this address. Um, Things like that you can verify. Of course, when the Form D is filed, all of that's filed with the SEC, so it's public information. Literally anyone can access on Edgar at any time. But these are some ways to validate the information, or um, the term sheet, to verify the lender terms or what type of loan they're getting. Again, you don't have to, if you're not comfortable sharing, or if the operator is not comfortable sharing, I'm always happy to get on a Zoom call or meet in person and we can look at that information together. But these are some ways as a passive investor you can kind of validate the deal and do background checks, deep background checks. Now I hire private investigators. Some people are like, "Oh, yes, it's crazy." But you have to do that because, and they're gonna find things. You'll be surprised. Sometimes that are supposed to be off the record, they actually find those things too. And you want to know about that because these are the people you're getting in business with, right? Will they catch everything? Absolutely not. I mean, there's always the possibility of error, but the more of these checks you do up front, the more you minimize. You don't eliminate, but at least you minimize the risk. The risk is always there. That unfortunately, the perfect checklist cannot eliminate.
All right. Well, we're just wrapping it up here at 7:58. If anybody has any other burning questions, Bessie, how can they get a hold of you if that's okay? Can we put something in the chat?
Absolutely. I'll put my information. So for passive investing insights, dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. A lot of educational content is there along with my information. For those looking to learn how to vet deals with confidence and ease, they can go to masteringmultifamilyunderwriting.com. I also post a ton of educational content there on specifically on apartment underwriting. And then on social media, I most frequently hang out on LinkedIn. That's my go-to place. Although by popular demand, I recently joined Instagram, so I'm learning the ins and outs of Instagram. And I have a YouTube channel at Dream, Believe, Achieve Real Estate. So if you're not in the mood of reading, but you want to listen to a quick video while you're driving or working out, then you will find that information there.
That was Dream, Believe, Achieve Real Estate, right?
Yes, let me see if I can grab the link.
Oh, okay, that would be great.
I
All right.
will.
And then while you're doing that, I just want to say to everyone, Bessie, thank you for bringing some clarity and some discipline to today's session. Your lens, and it really made a clear path for how to invest. And then along with that, we just hope that if you were on the call, that you take one of these ideas and you can implement them if you choose to invest the next time. Just doing your due diligence is absolutely key, as Bessie has said. Take a simple step, keep the momentum, stay connected about our future sessions. You can follow us all on Facebook, LinkedIn, and Instagram as well. We'll send out a replay and with the key takeaways and a follow-up email. We will also be hosting another webinar at the end of October. The title is To Be Decided, so we will keep that a little bit of a secret. So on behalf of the Capital Classroom, thank you for investing your time with us today. And remember to invest with confidence. So
Thank
thank
you.
you,
Thank
everyone.
you.
Thanks,
Fantastic.
Bessie.
For joining
Thank
us.
you.
Thanks.
Thank
Thank
you.
you.
Erin, Tammy, great to see you guys.
Thank you. It's
Great
good to
to
see you
see
all
you.
too. Have a great night.
you.
You do the
Bye-bye.
same.
Bye.
Thank you. Bye-bye.